This medium-term lending facility cut, you know what, that was the reaction, some would say, to a backdrop that's tough. How tough is it in China at the moment, given the data you've looked through?
It looks to be pretty tough, Manus. Weakness across the board in July. Retail sales down more than expected. Industrial production down more than expected, even though exports are holding up. Investment weaker, especially private sector investment. On the housing side of things, new home sales, new home prices, housing investment, all weaker. And that's why the central bank took the surprising decision that it did this morning to lower one of its key interest rate, really. It hadn't made that move since January. And while that move by the central bank in and of itself isn't going to be a game changer, because the problem in China isn't the cost of borrowing per se, it does speak to, though, how serious the authorities are viewing things right now, that they are pulling these levers and trying to put a floor under demand where they can. So the other big takeaway I would say is all of this data was weak. But the reason it's especially concerning is because July was meant to be the good month. July was meant to be the month when things picked up a bit of momentum again. The third quarter was supposed to be better than the second quarter and all the rest of it. But of course, this now underscores just how much pressure China's economy is actually under.
I'm just getting some notes into the inbox from Martin Malone at Oral, basically saying, after this next rate hike in the US, you're going to have this crossover between Chinese rates over US rates. And we haven't seen that in a decade, and that may well have a big currency impact. But the policy response that you've seen so far, given what Martin is saying here, do you think it's going to be, again, accelerated easing in these key interest rates, MLF?
Well, this is the big talking point, Manus. How will the authorities respond from here? You mentioned the central bank side of things. A lot of economists said today that move with the MLF is really more about optics. Like I say, that's not going to turn the economy around in and of itself, given what's happening in real estate and given what's happening with, of course, COVID-0. The reason they have been reluctant to cut interest rates is, to your point, that they didn't want to accelerate the flow of money leaving the country. The whole yield advantage story over the US is gone, with the Fed heading in the opposite direction. That's downward pressure on the yuan. It means money out of China. They didn't really want to add fuel to that fire, but it looks like they might have little option now, given the move they've taken this morning. I think the bigger focus will remain going forward, though, less on the central bank and more on the government. Will they delve into their bag of tricks to unveil more borrowing, more spending on infrastructure, especially at local government level, or will they perform something of a U-turn on other key policy areas, like in the housing market or on, of course, on COVID-0, Manus? So I think there are a lot of question marks now over how the government are going to respond. They've been fairly reticent to take major steps so far. They're adamant about COVID-0. So I think a lot of focus will be on perhaps the real estate sector and, of course, on local government borrowing and spending.